Sarah thought she was being smart with her credit cards. She had 3 different cards, always made her minimum payments on time, and figured she was building great credit. Fast forward 2 years later, and she's sitting in her car crying because she just got denied for an apartment. Her credit score? A devastating 580. Despite never missing a payment, she had unknowingly destroyed her financial future with one simple mistake that nobody warned her about. Sarah's story isn't unique. With Americans carrying over $1.18 trillion in credit card debt and nearly half of all cardholders carrying balances, millions of people are making the same critical errors that turn credit from a wealth-building tool into a financial prison. But here's what the banks don't want you to know. Sarah's fatal error wasn't late payments or maxing out her cards. It was something called credit utilization, and it's silently destroying credit scores across America. She was using 80% of her available credit across all her cards, thinking that as long as she stayed under the limit, everything was fine. What she didn't realize is that credit scoring models see high utilization as a massive red flag, even if you pay on time. Credit utilization makes up 30% of your credit score, but most people have no idea it even exists. The magic number? Keep your total credit usage under 30% of your available credit, and ideally under 10% for the best scores. For example, if you have one credit card with a $1,000 credit limit, you should never carry a balance more than $100 on that card. If you have 3 cards, each with a $1,000 credit limit, you should never carry a balance of more than $300 across all of those cards. But credit utilization is just one piece of a much larger puzzle that banks deliberately keep complicated. And the biggest piece of this puzzle will shock you. Payment history accounts for 35% of your credit score, making it the single most important factor in determining whether you'll get approved for loans, apartments, or even certain jobs. But here's what they don't tell you. It's not just about paying your credit cards on time. Every single bill that gets reported to credit bureaus affects this score. We'll talk about the credit bureaus later. Your cell phone bill, utility bills, even library fines can show up on your credit report. One missed payment can drop your score by 60 to 110 points, and it stays on your report for 7 years. 7 years! That's longer than most people stay at their jobs. The most dangerous trap? Autopay failures. Maybe your bank account was low, maybe you changed cards, or maybe the system just glitched. Doesn't matter. That missed payment is now a permanent scar on your financial record. The solution is ruthlessly simple. Set up multiple payment reminders and always pay more than the minimum. Speaking of which, there's another factor that can make or break your credit score that has nothing to do with how much you owe. Length of credit history makes up 15% of your credit score, and it's the reason why 18-year-olds often can't get approved for anything, even with perfect payment records. The system rewards people who have been using credit longer, which creates a catch-22. You need credit to build credit, but you can't get credit without credit history. Nearly 29% of Gen Z adults either don't know if they have a credit score or think they don't have one, leaving them completely unprepared for adult financial life. But there's a secret pathway that credit card companies don't advertise. Secured credit cards are the cheat code for building credit from scratch. You put down a deposit, usually $200 to $500, which becomes your credit limit. Use it responsibly for 6 to 12 months, and you'll have enough credit history to qualify for regular cards. But here's the crucial part. Never close your first credit card, even after you get better ones. That first card becomes the foundation of your credit age. Close it, and you're resetting the clock on your credit history. This is why some people with perfect payment records still have mediocre credit scores, but there's an even sneakier way the system works against you. Recent credit inquiries, or credit checks, make up 10% of your credit score, but the impact is immediate and brutal. A credit check is when a lender or other authorized party requests to see your credit report from a credit bureau. This happens when you apply for credit, like a loan or credit card, but also when other parties check your credit for things like pre-approved offers or employment verification. There are 2 main types of credit inquiries: hard inquiries and soft inquiries, which have different impacts on your credit score. A hard inquiry occurs when you apply for new credit, such as a credit card, loan, or mortgage, or even some apartment rentals. These checks can lower your credit score 2 to 5 points each time. Apply for 3 cards in a month, your score could drop 15 points overnight. The worst part is that these inquiries typically remain on your credit report for up to 2 years, broadcasting to every future lender that you were recently desperate for credit. It's like walking into a job interview with a sign that says, "I was just rejected by 3 other companies." A soft inquiry happens when you check your own credit report, when companies check your credit for pre-approved offers, like a new cell phone, or when employers check your credit for employment purposes. These do not negatively affect your credit score and do not appear on your credit report. But the credit scoring system has one more trick up its sleeve that most people never discover. Types of credit used accounts for the final 10% of your credit score, and it's the most misunderstood component. The system rewards people who can handle different types of credit: credit cards, auto loans, mortgages, student loans. It's like a financial report card that says you're responsible with various forms of debt. But here's the trap. People think they need to take out loans they don't need just to improve this score. Wrong. You should never go into debt just to boost your credit score. Instead, focus on the other 90% of factors you can control. A perfect payment history and low utilization will always beat artificial credit diversity. Now that you understand how credit scores work, let's talk about the plastic rectangles that can either build your wealth or destroy your life. Credit cards are simultaneously the best and worst financial tool ever invented. Used correctly, they build credit, offer fraud protection, and can even make you money through rewards. Used incorrectly, they become a financial quicksand that traps you in debt for decades. The average American household carries $6,000 in credit card debt, paying minimum payments that barely cover interest charges. At 18% APR, paying the minimum on $6,000 means you'll pay over $13,000 total and take 30 years to pay it off. 30 years to pay for stuff you bought in one day. But here's what the credit card companies don't want you to know. There's a simple rule that makes credit cards work for you instead of against you. Treat your credit card like a debit card. Never spend money you don't have. If you can't pay cash for something, you can't afford to put it on credit. This single rule eliminates 90% of credit card problems. When you swipe your card, the money should already be sitting in your checking account, ready to pay off the balance immediately. Credit cards become a tool for convenience and credit building, not emergency funding or lifestyle inflation. The rewards and cash back are just bonuses. If you're carrying a balance, you're paying more in interest than you're earning in rewards. A 2% cash back card means nothing when you're paying 18% interest on the balance. But even if you follow this rule perfectly, there are still landmines waiting to explode your credit score. Annual fees, foreign transaction fees, cash advance fees, late fees, overlimit fees. Credit cards have more fee structures than a casino. These fees can add up to hundreds of dollars per year, completely wiping out any rewards you might earn. Annual fees are only worth it if the card's rewards and benefits exceed the fee cost. For most people, a simple cashback card with no annual fee is the better choice. Foreign transaction fees typically run 3% of every international purchase, making that vacation a lot more expensive than you planned. Cash advance fees are the most dangerous. Using your credit card to get cash at an ATM triggers a fee of 3 to 5% plus immediate interest charges with no grace period. A $100 cash advance could cost you $105 the moment you withdraw it, plus interest that starts accumulating immediately. But there's one type of fee that can actually help you build wealth. Balance transfers, which means transferring the remaining balance from one card to a new card, can be a powerful tool for escaping high-interest debt. But they're also a trap for the financially undisciplined. Many cards offer 0% APR on balance transfers for 12 to 21 months, giving you a chance to pay down debt without accumulating additional interest. But here's the catch. Balance transfer fees typically run 3 to 5% of the transferred amount. Transfer $5,000 in debt, and you immediately owe $150 to $250 in fees. Plus, if you don't pay off the entire balance before the promotional period ends, you're back to paying high interest rates. The bigger trap? People use balance transfers as a way to free up credit on their original cards, then run up new debt. Now they have double the debt and twice the monthly payments. Balance transfers only work if you commit to paying off the debt and never using the cards again. And speaking of debt, there's a psychological trap that keeps people broke even when they're trying to do the right thing. Credit card companies are legally required to show you how long it will take to pay off your balance making minimum payments, and the numbers are terrifying. That information is usually buried in tiny print that most people never read. Making minimum payments feels responsible, but it's actually a wealth destruction strategy designed to keep you in debt forever. Paying only minimums is one of the biggest financial mistakes young adults make, trapping them in debt cycles that can last decades. The psychology is insidious. You see a minimum payment of $25 on a $1,000 balance and think it's manageable. What you don't see is that $23 of that payment goes to interest, meaning you only paid down $2 of actual debt. At that rate, you're not making progress. You're treading water in a debt ocean. The solution is simple but requires discipline. Always pay more than the minimum, ideally the full balance every month. If you can't pay the full balance, pay as much as you possibly can, not just the minimum. But even people who pay their balances in full can still destroy their credit with one common oversight. Your credit card statement closes on a specific date each month, and that's when your balance gets reported to credit bureaus. Even if you pay your balance in full every month, if you have a high balance when the statement closes, it looks like you're carrying debt. This trips up responsible credit users who pay their bills on time but have bad timing. They might charge $2,000 on a $2,500 limit card for monthly expenses, then pay it off when the bill arrives. But if the statement closes before they pay, it shows 80% utilization, which crushes their credit score. The solution is to make payments before your statement closes, or split your monthly payments into smaller chunks throughout the month. Some people even pay off their cards weekly to keep reported balances low. But there's an even more devastating mistake that can happen to anyone, even people with perfect credit. A single fraudulent account or missed payment can cause your credit score to drop significantly and remain on your credit report for years. Identity theft isn't just about someone stealing your money. It's about them stealing your financial future. Criminals can open new accounts in your name, run up massive debts, then disappear, leaving you to deal with the wreckage. By the time you discover the fraud, your credit could be destroyed and it can take years to clean up the mess. The scariest part? You might not know it's happening until you apply for a loan or apartment and get rejected. That's when you discover mysterious accounts on your credit report that you never opened. The protection is simple but crucial. Check your credit report regularly. You're entitled to a free credit report from each bureau every year, which means you can check your credit every 4 months by rotating between bureaus. Speaking of credit reports, there's one section that most people completely ignore, but it could be costing them thousands. Your credit report contains more than just account information. It has your personal details, name, addresses, employment history, even public records like bankruptcies or tax liens. Errors in this section can be just as damaging as fraudulent accounts. A simple misspelling of your name, an old address that never got updated, or employment information that's wrong can cause your credit applications to get rejected. The automated systems that process credit applications are looking for exact matches, and any discrepancy can trigger a denial. Even worse, these errors can indicate identity theft or mixed credit files. If someone with a similar name has bad credit, their information might get mixed with yours, dragging down your score through no fault of your own. The fix requires vigilance. Review every section of your credit report, not just the accounts. Dispute any errors immediately and keep documentation of all correspondence with credit bureaus. But there's one final trap that catches even financially savvy people. When people clean up their finances, their instinct is to close old credit cards they no longer use. This seems logical. Fewer accounts means less complexity and lower fraud risk. But closing accounts can actually hurt your credit score in multiple ways. First, it reduces your total available credit, which can increase your utilization ratio even if your spending stays the same. If you have $1,000 in debt across 2 cards with $5,000 limits each, you're at 10% utilization. Close one card, and you're suddenly at 20% utilization. Second, closing your oldest accounts reduces your average account age, which can lower your credit score. That first credit card you got in college might have terrible rewards and no benefits, but it's also proof of your long credit history. The better strategy? Keep old accounts open, but use them occasionally for small purchases to keep them active. Set up a small recurring payment like a streaming service, then set up autopay to cover the balance. This keeps the account active without requiring you to think about it. Understanding credit isn't just about avoiding mistakes, it's about leveraging the system to build wealth. Good credit opens doors to lower interest rates on mortgages, auto loans, and business loans. The difference between a good and bad credit score can mean tens of thousands of dollars in interest savings over your lifetime. A person with excellent credit might qualify for a lower mortgage rate, while someone with poor credit pays more. On a $500,000 home mortgage, that difference could cost an extra $50,000 in extra interest over the life of the loan. What could you do with an extra $50,000? The same principle applies to business loans, auto loans, and even insurance rates. Good credit is like a permanent discount on all of life's major purchases. Bad credit is like a permanent tax on everything you buy with borrowed money. But building good credit requires patience and discipline. There are no shortcuts, no quick fixes, and no magic tricks. It's about consistently making smart decisions over years, not months. Start by checking your credit report from all three bureaus: Experian, Equifax, and TransUnion. Look for errors, fraudulent accounts, and outdated information. Dispute anything that's wrong immediately. If you don't have credit yet, start with a secured credit card or become an authorized user on someone else's account. Use the card for small purchases and pay the balance in full every month. If you already have credit, focus on paying down balances and keeping utilization low. Set up automatic payments to ensure you never miss a due date. Use credit cards for convenience and rewards, but always pay the full balance. Most importantly, be patient. Credit building is a marathon, not a sprint. The decisions you make today will impact your financial life for years to come. The credit system might seem designed to confuse and trap you, but once you understand the rules, you can make them work in your favor. Sarah learned this lesson the hard way, but you don't have to. With the right knowledge and discipline, credit becomes a powerful tool for building the financial future you deserve. The choice is yours. Let credit work against you, or master the system and let it work for you. Your future self will thank you for making the right choice today.